This is Anthony Rinaldi, founder and managing principal of Saxum Real Estate. I'm having a conversation with my friend and colleague, Chad DeBolt. Chad, thanks for joining us on this call from New Jersey. I'm up in Boston, and obviously the world has changed, and we, as everyone else, is dealing with it.
That's right, Anthony. It's really unique times we're dealing with here. Mark Twain once said, history doesn't repeat itself, but it rhymes. And there's a number of, just different questions that's been going on in the market in terms of, is this time different than 2008? Is it worse in general? And I think we could both agree that, between all the conversations we've had in both real estate and with other colleagues in finance, we're definitely dealing with a unique and challenging environment.
For sure. For sure. We both have a pretty extensive experience, decades worth or even more, in our respective focuses prior to coming together, obviously, at Saxum. When I cut my teeth really coming out of the financial crisis, the global financial crisis in 2009, 2010, was fortunate enough to work on a number of special servicing projects that were essentially distressed assets here, really mostly in the Northeast, but specifically in New Jersey, which was hit very, very hard at the time. So that gave me a lot of light and experience in issues of distress, in times of stress, in financial uncertainty. Pretty thankful for having that experience, especially as we're coming into what may be the next, clearly is the next downturn. And Chad, on his side, Chad, you want to give your background?
Sure thing. Yeah, so in the beginning of my career, I was basically trading in the belly of the beast during the GFC, which is another name for the global financial crisis. And when you talk about being at the epicenter of it, I truly was. I tell people I was trading at Lehman Brothers, which it still holds as the largest bankruptcy in history. But not just that, I was actually trading Fannie and Freddie agency debt securities, and it's kind of a unique situation because about a week before Lehman went bankrupt, Fannie and Freddie Mac went into conservatorship, which is partially almost like a bankruptcy. And within that week, basically the product I traded was arguably bankrupt, and then a week later my company was bankrupt. So there are a lot of things obviously in life. You learn a lot more in challenging situations than you do when things are easy. And I think I gleaned a lot of information out of those moves. A lot of those lessons are very transferable to any markets investing in general. Which was part of my big move into real estate, because I learned during those times real estate is a unique asset class for a number of reasons we could talk about later.
Yeah, so that's what's actually really interesting about this conversation in particular, as well as just our kind of dynamic of different backgrounds but coming together as one on the real estate side is you trading mortgages in the middle of the financial crisis when the world is coming to end, essentially at the time, or what it felt like, at least the financial world. You truly were at the belly of the beast, as you said. And as we all know, real estate being a lagging industry, 2 years later, a year and a half later, really is when I was dealing with the rollout of these special servicing assets that have gone into special servicing, receivership, foreclosures, that were essentially where real estate was starting to bottom out. It was a really unique experience, I guess, for both of us. And as you said, you learn 10 times as much in failures as you do in success. And a lot of those experiences have guided us, myself, Saxum, over the last 10 years. So, it's great to get on a call and talk about this, and really curious to, overall, like, what's your take on what's going on in the world, the volatility that we're seeing?
I mean, when you look at what's going on right now, one of the biggest questions we hear out in the market is, what are the similarities? What are some of the differences of what we're seeing now versus back in 2008, 9, and 10? And what you see basically is some of the simple similarities that we see out there are that obviously we're in a very high vol environment. That's obvious. If you look at the VIX, which is one of the main measures of volatility in the market, is hit similar vol levels that back in the crisis over a decade ago. This is it's affecting multiple assets, right? It's not just one particular asset classes, because the interesting thing about investments in financial markets is they're all woven together in multiple different ways, from financing, which flows up to the valuation. So it's affecting all markets. Another similarity is this is global in nature. The banks basically led the move 10 years ago, but it was banks on a global basis, which was, really unique. And that also, part of getting out of that recession from before, it prompted global fiscal monetary policies in a coordinated fashion, which is truly remarkable, where you see global central banks all easing and lowering, their rates in parallel, which is unique. And that's what's going on right now. We're seeing it in Europe. We're seeing it in Asia, and obviously we're seeing it in the U.S. Those are some of the similarities, but it kind of really stops there because again, this is a unique situation. Even though real estate lagged a couple years in the move a decade ago, it was really at the center of it to start, and it was at the center of it in the financing markets. And the banks were obviously the culprits back then. And it was kind of threefold. It was bank leverage was way too high. And it wasn't just high leverage, it was on bad credit also. When I was at Lehman, I think, depending on who's counting, I think Lehman was almost, levered in the mid 30s to 40s. Now banks, and this is partially Treasury and Fed induced, are much lower given, different restrictions, which keep them almost under 10 times levered. So, banks were much more levered, and they were extending credit to people they shouldn't have, and to markets they shouldn't have, which real estate, residential, and commercial, were at the center of that. One other big difference from then to now was it was also financially engineer driven. And by that, I mean all these unique synthetic CLOs that were on the market, which are basically aggregating all these different securities into different products, which were leverage on top of leverage, basically produced a house of cards. So that's what basically happened last time. And, and what's so different to this time is you could put your finger on it last time. Last time, the banks got ahead of themselves. And also Fannie and Freddie were very involved with that too, obviously, which is directly linked to the government. Banks got ahead of themselves. They had to take their medicine, like any sick patient should. And they did. And it took a while to get out of it. This time around is different. And the coronavirus is, at front and center, but let's not forget about what's going on with oil right now, which dropped under, $20 a barrel, given, these price wars with Saudi Arabia and Russia. So, it's a challenging market out there for sure. I'd be curious, how does that look from your lens?
Good question. That's been the question that we've been pondering since right before this crisis really took the world and the United States by storm. It's going to have multiple various implications to the overall real estate market. What you've pointed out, right, is in the global financial crisis, credit was bad, everything was over levered, asset prices were, way out of whack, and that all came, to roost in a colossal way, right? Here is you have a global pandemic, a black swan event, to global event, and you have a global response. Fortunately, obviously, at the time, the U.S. economy was roaring, things were going well, the real estate market was doing really well, in my opinion, broadly on the commercial side. But this is what's going on here is, besides the fact that you have all of these kind of macro issues, when you look at it on the real estate, I think it heightens focuses on certain asset classes that maybe we're already starting to have some trouble, that will not be able to weather out this storm. I mean, you'd started the trouble in the hotel and leisure space in certain markets. Others, it was performing quite well. For now 5-6 years, have been talking about the death of retail, which was almost even over talked about. But here you've got asset classes that are maybe challenged, and we're maybe having some underlying issues, and those challenges are now heightened. Or just quite frankly, some of these, they could have been perfectly performing assets, and now, given what's going on, there's no model that could have underwritten a scenario like this. For example, if you look at the hospitality space, typically on the worst lows, they're underwriting a 60% occupancy rate. At least they're in a position to be paying their operating expenses and debt service. Now that occupancy rate is like 0, maybe 5%, maybe 10%. They could never, that's breaking the model. And Chad, you always say that, and we talk about it. It's literally breaking the model. No one could have predicted it. I mean, outside of real estate, you look at it's the same thing with airlines. No one could have ever underwritten a situation where you have a prolonged period of almost limited to no use. We've been following, obviously, the CMBS debt. And if you look at that, let me take a step back, actually. And so when you looking at how this is going to impact the real estate industry, let's start with the capital flows. Like, at the end of the day, I think there's two sides, right? It's what's happening on the day-to-day asset level is one side of the paradigm. And then where does the capital flow is on the other side. So if you look at the capital flows, you start to see that that's where the chink in the armor is right now. And then obviously you're having issues on the tenant sides, and that's where it's going to come together and create some sort of challenges for real estate. But well-positioned, good quality assets, I think we'll clearly ride out that storm. But if you look at, so CMBS debt, obviously massive amount of liquidity in that market, is now freezed up entirely. They had enormous amounts of leverage in the hotel space. If you track their loans, 35% of all of their
currently, and I think that number is going to escalate, is currently it's 35% of all hotel loans are in default. They're not going to be able to pay their debt services. They're going to have to go into receivership. They're going to have to get restructured. Assets are going to be lost, and there's going to be significant aftermath associated with that in specifically in that sector. We talk about it all the time, is when after the global financial crisis, when the regulations were changed, obviously, to address some of the issues that caused that crisis. The banks were kind of regulated on where they could lend, the amount they could lend to, asset classes, construction types, in a broad range of the spectrum of type of risk profile. And what ultimately happened, debt funds, REITs, and institutional lenders kind of stepped in and filled that liquidity, right? Because there's always a need for liquidity. So even if you regulate it, there's someone else is going to fill that, and maybe they'll fill it at a little bit more expensive money, and they're a little more opportunistic, but they're going to fill that need for liquidity. So they came in, they filled that need, and they ultimately were getting facilities, ultimately getting a lot of their lending facilities direct from either REITs themselves or even direct from the financial institutions. And now those banking institutions have to mark to market their assets, and if they're doing that, they're mark to marketing their assets and realizing that there's a significant amount of devaluation, specifically largely in some of the sectors we just talked about, that is ultimately freezing up liquidity, meaning they have to call their credit lines to those debt funds, to those institutions, call them back, and are not providing liquidity to them, and therefore those groups are not providing liquidity to the ending asset. So it kind of creates a stalemate, stagnation in the flow of capital, and that's really where the dominoes start to fall. And if that's not corrected, I think we're going to start to see significant implications in our industry. So it's going to be interesting to watch. Is I think it all starts with the lending and where the flow is, because I think everyone has come to the conclusion that rents are going to be tight. Tenants aren't going to be paying rents for the next 30, 60, 90 days at least until we get our arms around this. Maybe through some of the government stimulus, landlords will be able to get some of those dollars back. But as tenants aren't paying because they have zero revenue, so the landlords are going to then they still have operating expenses, and debt service going to have to request forbearance from their lenders. Hopefully their lenders will work with them to help ride out this storm. But ultimately, when liquidity freezes up in the market, that causes stress, a massive ripple effect of stress throughout the entire industry. I mean, Chad, this is probably one of the issues, I think, where I see most focus in terms of stress coming in the overall real estate market.
I think that's spot on. Debt markets generally lead when you have recessions. Rates have been low for a while. We've talked about curves going inverted, so longer end rates being lower than actually shorter end rates. And when that happens, the bond market's telling you something. And usually that's what happens is, a lot of people that look to short stocks and other markets, they look at debt loads and debt service on companies across any industry. That is one of the biggest issues right now, which the market is trying to grapple with in terms of how long is this recession? What does this actually look like? And that's what's driving this fall. Everyone talked about like this is the fastest bear market in history. By far, not even close. Most bear markets take over 2 years, or you're sitting in the bear market to actually get to the full, peak to trough. And this market was in a matter of a month. We were over, almost 25, 30% in some cases. And people keep asking what's happening. And there's really two things there. One thing is that, remember I told you banks' leverage is much lower, which sounds good on the financing side, but that doesn't mean they don't lend. But what that means for risk takers, which I used to be, traders, people investing the firm's balance sheet, the firm's capital to put on trades to provide liquidity to buyers and sellers. That is over. That game does not exist anymore. Banks don't allow traders to take the risk they used to. Traders take 20%, 30% of the risk they used to. When markets get volatile, traders become brokers almost. They don't become risk takers like they used to be. And that means if an account wants to sell, you're willing to work an order of where another account might buy it. And it's not a price that's live at that time. So that's what's one of the main reasons causing a lot of this volatility. And the volatility from that market has also been driven higher by all these algos that are doing the same trades, which people talk about. So those are two high level factors, which I didn't want to miss because I think they're one of the biggest things that people talk about, what's driving the volatility is the actual structure of banks.
For sure. That's actually a great place to stop the conversation. I think we could dig a lot deeper into it, and maybe we will save it for a future discussion. Thanks, Chad, for being here and sharing your perspective on the market. You've always got a very insightful take on what's going on in the world and how it relates to real estate. I really enjoyed our conversation and look forward to continuing it.
It was a pleasure. Enjoy the conversation and look forward to more to come.